Maneesh, great to have you here. Wondering about your overall read. In some respects, we're getting what might have been expected after a 27% gain last year, anticipation of a Fed rate hiking cycle as earnings growth sort of steps down a little bit. What are you looking for, I guess, for clues that maybe this downturn might be able to pause for a while?
So I think the key thing here is, like you said, the main driver for the softness that we're seeing year to date has been the Fed's hawkish pivot, and that was unexpected in the sense that it's going to do both taper, start of the hiking, and QT at the same time, all in 1 year, while that happened over the span over multiple years last time. So that's the reason why equities are under pressure. But like you said, I think the main thing I'm looking for is how will earnings play out. And specifically, as you said, earnings have been very strong for the last 1 year. But the main reason for that was a goods consumption binge that we all did since COVID. And so the interesting thing would be that, to some extent, earnings might decouple from GDP. The GDP might still be strong because of services rebounding and, let's say, inventory restocking. But earnings could be soft because they have historically been driven much more by the goods consumption. So on that front, the weak retail sales we saw last week was the important precursor of what might be coming down the road.
So do you think there's outright downside risk to current year earnings forecasts at this point? Because the pattern has obviously been massive beats versus the consensus, even if this quarter the estimates have not gone up very much.
So I would say for this particular quarter, I think they're probably going to be okay because, like you said, we have had beats. We think that the beats are going to slow down now, especially because the beats we think were driven by this unexpected amount of goods consumption that happened. So that will slow down. So our baseline is that we're going to be okay, but I think the risks are definitely to the downsides. That we are slightly above consensus right now for earnings for this year, but that is probably as good as it gets. And that's actually important for the Fed hike situation because historically, as you know, the start of the Fed hike actually has not been that bad for equities. But that's because even though valuations continue to go down, earnings momentum continues because the Fed is, hiking to a hot economy. This time, it could be a little bit different because, like I said, earnings probably have more downside risks as compared to previous times.
So, Maneesh, given the conversation and how you're analyzing this right now and the shift away from goods-based consumption, where should investors be putting money to work? Where do you see opportunities under the hood, if you will, across the major averages?
So I would say, I think the usual metric of sort of looking for cheaper stocks, cheaper valuation stocks makes sense. So one of the things that has happened is that although, overall index is down, it feels painful, but there is much more pain in stocks which are highly valued. So looking at different sectors, we think consumer discretionary, industrial, software, those are the sectors which are highly valued, and that could have some more pain. In particular, consumer discretionary, we are underweight because I think that could have some more pain from this slowdown in goods consumption. On the positive side, the stocks that we like are financials. We also like FanMags as a whole because although you could call them as growth stocks, they are really now cash cows in some sense. So they should be more resilient in the current environment. And we also like the healthcare sector as the one defensive sector which is probably going to do better compared to the other defensive sectors.